Welcome to Protea Academy, education for your business to help you be successful. My name is Zane Stevens. I'm the founder of Protea Financial. Today I want to talk about the balance sheet. What is a balance sheet? Balance sheet is also known as the statement of financial position. The balance sheet is a financial statement that provides a snapshot of your company's assets, liabilities, and equity at a specific point in time. Fundamentally, the balance sheet gives you a snapshot of the accounting equation. And a reminder, the accounting equation is assets equal liabilities plus equity. The balance sheet is one of the most important tools for assessing the health of your business. This document provides a snapshot of your business's financial position at an exact point in time and gives you a breakdown of all your assets, all your liabilities, as well as the overall equity of your business. Understanding that a balance sheet provides you a lot of in-depth detail about what you own, what you owe, and how much you have left in the business is a key indicator of how you're doing. The key purpose of the balance sheet is to provide a clear picture of your company's financial health and position. It is there to help stakeholders, including investors, lenders, and management, assess the company's financial strength and stability, and is there to help facilitate informed decision-making regarding investments, lending, and strategic planning. While the balance sheet provides a snapshot of your company's financial position at a point in time, the income statement or profit and loss statement shows the company's financial performance over a period, and the cash flow statement tracks the movement of cash in and out of the business. A well-constructed balance sheet provides valuable insight, and there is a lot of risk around an inaccurate balance sheet. Neglecting your balance sheet will lead you to making poor business decisions and will cost you money in the long run. An inaccurate balance sheet will mislead investors and lenders. An inaccurate balance sheet can distort your business's financial position, leading for people to make flawed decisions on the data provided. If you get it wrong, this can leave you in a bad stead with lenders who might decide to pull their loans or investment from your business and leave you in a situation where legal disputes could occur. Try and make sure that you focus in on the accuracy of your balance sheet, because the risk of getting it wrong can be very pricey. The balance sheet being accurate will also give you the ability to ensure that your profit and loss statement is accurate. If the balance sheet is fully reconciled, there can be no items on the balance sheet that should not be there, and thus will be flushed to the profit and loss statement. If it hasn't been done for a while, this could lead to some short-term distortion in the numbers, but if done on a regular basis, it will give you the trust and peace of mind that your profit and loss statement is accurate and you have a true picture of how your business is doing. Without an accurate view of your financial health, due to an unreconciled balance sheet, you may make poor operational decisions. Some examples is you'll be overspending on equipment that you might already have or have not had long enough to consider replacing. Additionally, if you get your cash balances wrong or overstate your liabilities, you might be sitting on too many assets that could have been invested in other parts of your business to help with growth or obtain a return on the excess cash. When you go to sell your business, they will want to see an accurate balance sheet. The balance sheet will be looked at in detail to ensure that what they're buying is what you're telling that you have. Lastly, an inaccurate balance sheet will lead to the loss of credibility with investors and bankers. And when you lose credibility with your stakeholders, it is very difficult to get them back. An inaccurate balance sheet can have very long-term repercussions of your business and the ability for you to stay operating. I strongly urge you to prioritize accuracy and consistency of your balance sheet. I highly recommend hiring a good accounting resource that is focused in on reconciling your balance sheet regularly. I also encourage all business owners to review their financial statements on a regular basis and ask questions about the financial statements. If something looks off, ask them about it and ask for backup to show where those balances are coming from. Having an accurate balance sheet is the first step in having accurate financial statements that will allow you to make better business decisions and give you the best chance of being successful.